session, we're going to cover one of the most important accounting adjustments you'll encounter, accrued revenue. By the end of this lesson, you'll understand what accrued revenue is, why we accrue revenue, the accounting principle behind it, the journal entries, where it appears in the financial statements, how accrued revenue affects profit, what happens when the invoice is eventually issued, how accrued revenue works over multiple months and common mistakes. This topic appears throughout financial accounting and is fundamental to producing accurate financial statements. Let's begin with the accounting principle that drives accrued revenue. Why do we accrue revenue? The reason comes from the accruals concept. The accruals concept says, revenue should be recognized when it is earned, not when cash is received. This is one of the core principles of accounting. The question accountants ask is, has the work been performed? If the answer is yes, then revenue has been earned. Even if no invoice exists, no cash has been received, the customer has not yet paid. The business has still earned the revenue, therefore revenue must be recognized. This ensures the financial statements present a true and fair view. What is accrued revenue? Accrued revenue is revenue earned but not yet invoiced or received. Think of it as, we have done the work, but the paperwork and payment will happen later. Examples include accounting services provided before invoicing, consultancy work completed at month end, legal services completed before billing, construction work performed but not yet billed, and the business has already earned the income. Therefore, accounting must recognize it. Let's imagine you run a marketing agency. During January, you complete work for a client worth £5,000. The work is finished on 31st of January. However, the invoice won't be issued until 10th of February. So the revenue was earned in January, therefore January must show revenue £5,000. Journal entry is debit accrued revenue £5,000 and credit revenue £5,000. Revenue increases with a credit. The business is now owed money. That creates an asset. Assets increase with a debit. Let's look at the financial statements. Statement of profit or loss. Revenue on 31st of January is £5,000. This increases profit. The revenue belongs to January because the work was performed in January. Statement of financial position. Current assets include accrued revenue. Why is it an asset? Because the business has earned the revenue but has not yet received payment or issued the invoice. The business has a right to receive the money from the customer. Future economic benefit exists. That meets the definition of an asset. So, revenue of £5,000 appears in the statement of profit or loss, and accrued revenue of £5,000 appears in the statement of financial position as a current asset. Now let's see how this works across 2 months. January work was completed for £5,000, no invoice issued. Adjustment we made is debit accrued revenue £5,000 and credit revenue. January financial statements. Profit or loss has revenue £5,000 and balance sheet or statement of financial position has accrued revenue £5,000. On 10th of February, the invoice is issued to customer for £5,000. What happens now? Revenue was already recognized in January. The invoice does not create new revenue. It simply converts one asset into another. When the invoice is issued, debit accounts receivable £5,000 and credit accrued revenue £5,000. Notice, no revenue account appears. Revenue has already been recognized. All we're doing is replacing accrued revenue asset with trade receivable asset. The customer now owes us through a formal invoice. Accounts receivable is debit £5,000 now and accrued revenue £0. Now let's assume the customer pays. Bank receives £5,000. Journal is debit bank £5,000 and credit accounts receivable £5,000. Again, no revenue appears. Revenue was recognized back in January. This transaction simply converts accounts receivable into cash. Let's look at the full transaction flow. Step 1. Work completed. Debit accrued revenue and credit revenue. Step 2. Invoice issued. Debit accounts receivable and credit accrued revenue. Step 3. Customer pays. Debit bank and credit accounts receivable. Revenue appears only once. Let's look at some common mistakes. Mistake 1. Recognizing revenue when cash is received. This is incorrect. Under the accruals concept, revenue is recognized when it is earned, not when cash is received. Mistake 2. Recognizing revenue again when the invoice is issued. This is incorrect. The revenue has already been recognized when the service was provided. Issuing the invoice does not create additional revenue. It simply converts accrued revenue into a trade receivable. Mistake 3. Forgetting that accrued revenue is an asset. Remember, the business has earned the revenue. As a result, it has a right to receive payment. This right represents a future economic benefit. Therefore, accrued revenue meets the definition of an asset. Mistake 4. Ignoring the month-end adjustment. This is incorrect. Revenue would be understated. Profit would be understated. Assets would be understated. As a result, the financial statements would not present the correct performance and position of the business. Remember these 4 key points. Revenue is recognized when earned. Accrued revenue is revenue earned but not yet invoiced. Accrued revenue appears as revenue in the profit or loss account, as a current asset in the balance sheet. When the invoice is issued, debit accounts receivable, credit accrued revenue. No additional revenue is recorded. Before you go, let's see how much you've understood. Try answering these questions yourself. Suppose a business completes consultancy work worth £8,000 on 31st of March. The invoice will not be issued until 15th of April. Should revenue be recognised in March or April? What is the journal entry required to recognise accrued revenue? Why is accrued revenue classified as an asset? Which financial statement shows the revenue? Which financial statement shows the accrued revenue? What happens when the invoice is eventually issued? Should additional revenue be recognised when the invoice is issued? What happens to accrued revenue when the invoice is issued? What would happen to profit if the accrued revenue adjustment was ignored? What would happen to assets if the accrued revenue adjustment was ignored? Is revenue recognised when cash is received or when it is earned? Pause the video and see how many you can answer. The answers are posted separately in the accrued revenue post so you can assess your understanding and identify any areas that need further revision.